Let's talk about RSP today and everything you should know about it. RSP, the Registered Retirement Savings Plan, is an account that helps Canadians to grow money for their retirement. It sounds simple, but there are a few important things you want to know about your RSP to use it to the max. So how does RSP work exactly? What kind of benefits will you get and what pitfalls do you want to avoid? We'll discuss all of that and more in this video, so make sure you watch it all the way to the end. Hey, how's it going? This is Thomas, here to help Canadians to make better choices on their retirement, wealth, and insurance. My goal is to make sure you can take one or two things home and implement right away. Make sure you hit that subscribe button so you won't miss my weekly video. I structured this video into 3 parts. First, we're gonna talk about the benefits of the RSP, then what other things you need to watch out for, and finally, I also want to talk about a few common misconceptions that people have about the RSP. And let's go! In general, the RSP has 2 big benefits and 2 side incentives. Number 1, it helps you lowering your taxable income, meaning you're paying less tax, and especially for those who are in 9 to 5, that also means you're getting a bigger tax return. It helps you grow your investments tax-free within the accounts until you take it out. You might ask, if I have to be taxed either way, then why should I do it? It's because instead of getting taxed now, a smart investor will always want to do tax later. That time helps you to have more compounding growth and be prepared for the bill. But how does that work exactly, and how can you maximize the benefits? Heads up, I'm not an accountant, so I will give you the ballpark figure only. For the exact number, please go to your accountants, okay? Let's look at the tax deduction first. Many people call the RRSP a tax later account. This is because when you put money into the RSP, you don't have to pay tax on the contribution until you take it out. Let's say, for example, you earned $70,000 in a year. And to make the math easy, I will round the tax bracket at 18%, meaning you have to pay $12,600 to the CRA. And let's say you put $10,000 into your RSP, that will reduce your taxable income from $70,000 to $60,000. And your tax bracket will now drop to 16%. So instead of $12,000, which now we are paying $9,600 to the CRA, so you save approximately around $3,000. Normally, you get this as a tax return in April. Also, now you have additional $10,000 in your bank accounts. Lowering the taxable income within the RSP is especially useful for people who are in a higher tax bracket, and I'll explain that in detail in a moment. First, let's look at how to grow your investments within the RSP. As I said, RSP stands for Registered Retirement Savings Plan, and that's why many people think it's a saving account. But please, treat it as an investment account. You can hold stocks, bonds, other investments in your RSP, and there's no capital gain, interest, or any other taxes within the account. That money is protected from tax. The general idea is that you want to put money into your RSP when your income is high because you'll be in a high tax bracket, and you take the money out when your income is lower, which is usually during retirement. Keep in mind, when you take the money out, it counts as income and you have to pay taxes. In theory, if your income is low, then your taxes will be relatively lower. Then Thomas, how do I know if my tax bracket is high enough to make the RSP worthwhile? Generally, there are many layers of tax brackets that includes both provincial and federal, so it can be very confusing. To make it simple for you, I usually like to break it down into 3 tiers. The first tier goes up to an annual income of about $40,000. The second one is up to $80,000, and the third is anything above. And usually, if you're in the first category, don't worry too much about your RSP, focus more on the tax-free saving. Vice versa, if you're in the third tier, I highly suggest you leverage the RSP to further boost your saving. Knowing your tax bracket will help you to maximize your RSP benefits, and for an accurate number, please go to the professionals. By now, you know that an RSP has attractive benefits, but there are a few things you want to keep in mind. The first thing is, there's a limit to how much you can contribute to your RSP. In 2021, the contribution limit is $27,830 or 18% of your previous income, and that's the upper limit set by the CRA. And for any unused room, you can carry forward to next year. So for example, if you make $100,000 in 2020, your RSP room in 2021 will be $18,000. You might be wondering, what counts as income then? Some example will be your work income, income from your self-employment, rental incomes, and a few more. And if you incorporated, paying yourself in dividend will not increase your RSP room next year. If you have a pension plan, that will share the same RSP room, so keep that in mind. The next thing to be very mindful is the contribution time frame. Normally, you have one whole calendar year to do it, but the CLA also lets you to use the first 60 days of the year to count towards last year's contribution as well. The bank will market this as the RSP season and always promote the RRSP loan. By the way, if you want to know more about the RSP loan, rather if you should do it or not, let me know in the comments. So if you have extra saving and want to lower down your tax bills, you have until the 1st of March to decide, but after that, it's too late. Now let's talk about the downside a little more. Why lots of people prefer tax-free saving instead of the RSP? Mainly because of the flexibility in withdrawal. Since tax-free saving is using after-tax money to invest, therefore you cannot deduct your income, but you don't have to pay any taxes when you withdraw. Versus RSP is using pre-tax money, meaning you can deduct your taxable income right away, but the withdrawal will be treated as income of that year, meaning 100% will be taxed. And since our Canada pension plan, one of the government retirement benefits is income related, withdrawing too much in the RSP might reduce your CPP benefits. Also, another noteworthy thing about the RSP is the maximum age limit. Once you turn 71, the RSP automatically become a RIF. Registered Retirement Income Fund has a minimum withdrawal, meaning that you're forced to withdraw a portion of the pie and you have to pay tax accordingly. So keep that in mind for your retirement. There are a few things people often misunderstand when it comes to RSP. Number one is that most people think that RSP itself is an investment, and that is wrong. An RSP is just an account, not an investment. You can have term deposits in there. You can also hold stocks or bonds inside your RSP. You will be surprised every time I ask a client, what do you do with your RSP accounts? Most of them have no clue. Like a coffee mug, you can put water in it, you can put coffee, and if you want, you can even put beer in it. You can open several RSP accounts, but the contribution limit stays the same. Another misconception is that for RSP, you cannot take the money out until your retirement, and that is not true neither. RSP itself do not lock your money. The downside of taking the money out is that you have to pay taxes on, and you lose the contribution room, but there are no additional penalties. There are two situations in which taking the money out of your RSP can be tax-free: when you want to buy your first home or when you want to go back to school. If you want to buy a home, you can use the First Home Buyers Plan. It allows you to take out a maximum of $35,000 tax-free. Keep in mind that you have to pay this money back in the span of 15 years after, so imagine it as giving yourself an interest-free loan. If you want to invest in your own education, you can take out up to $20,000 and pay it back in a time span of 10 years. These plans can be beneficial, but they will also reduce the amount of time you have to grow your investments. It can be a good idea to leave all your monies inside your RSP and save up for a home elsewhere. For ladies, a little RSP hack for you. If you're heading to your maternity leave this year, you can consider lowering your last year taxable income by contributing into the RSP in the first 60 days of the year. That way, you'll receive extra tax return. Then during your mat leave this year, you'll be getting EI, which means your income is 50% lower. Now, you take the RSP out to even out the tax bills. Lastly, my company provides an RSP matching, but I don't want to take it because I simply feel the money is locked in for a long period of time. Listen to me, if your company offered this to you, take it. First of all, it's free money, and it doubles your tax return. So it's like a guaranteed 100% return on your contribution. It will be stupid not to take advantage of it. And even if you leave the company, 9 out of 10 times you can transfer it back to your own personal RSP. In the next coming weeks, I want to talk about the pros and cons for the RSP. Should you consider an RSP loan, or what is a spousal RSP? So stay tuned for that. And now, I'd love to hear from you. What is your experience with the RRSP? Are you currently using it? And usually, what do you do with it? Let me know in the comments. If you have any questions, feel free to reach out and I'm more than happy to assist. As always, thanks so much for watching and I'll see you again next week.